Oil prices under pressure today as investors dialed back fears of a supply shock after Donald Trump signaled a possible easing of tension with Tehran. Let's go to Rebecca Babin on this, senior energy trader at CIBC Private Wealth. Thanks for joining us today.
Thanks for having me.
Should investors be a little cautious in assuming that things are going to go quietly resolved between Washington and Tehran?
Yes, I think traders should be very cautious making that assumption. And I think the price action you see today actually reflects that traders are still pretty cautious. We are down 4%, and let's call it $3 in WTI. But if we think about how much premium was built in over the last several weeks, it was closer to like $7 or $8 of kind of risk premium built in as it looked like there was going to be escalation between Iran and the US. So we've given back, I'm going to call it a little less than half of the premium that we've been accumulating, which tells me the market's saying, okay, I'm recalibrating my risk here on a potential supply disruption, but I'm certainly not making the assumption that we are going to see a quick resolution or definitely see a resolution. So this is a market that lives and dies headline to headline on geopolitical risk at this point. And so we're not typically used to seeing 3 to 5% moves, but in the context of the way things are unfolding, this type of action is actually not a panicked or an extreme response. It seems actually fairly calibrated.
Okay, let's talk about what else has changed, sort of the outlook for oil, supply disruptions in Kazakhstan, the U.S. winter storm also put some pressure there. What else is playing in?
Yeah, so in January, crude kind of hit the trifecta, to use a horse racing term, where we had geopolitical risks that rose. We had unplanned supply outages, as you mentioned, in the U.S., impacting 11 million barrels of supply over the course of the last 2 weeks. We had the CPC pipe having restart issues and the Tengiz fire, right? All of those things coalesced at the exact same time. Geopolitical risk was increasing, while at the very same time, positioning was flipping from maximum short in the systematic trading community to a maximum long positioning. So all of these events took place at the very same time. And to put a little context around the size of that positioning move, if we came into January with CTAs looking at max short at around $30 billion, they have now flipped the other way to being long close to $20 billion. So it's a $50 billion kind of net positioning flip. And obviously crude is a very deep market, but that's pretty notable from a positioning standpoint. So the trifecta really hit all three things that create a tremendous amount of volatility for crude traders.
Okay, then we'll get into the next factor here, which is OPEC, of course, announcing it's going to leave production levels where it is for now. But Saudi Arabia has indicated lower oil prices are impacting state revenue. So I'm wondering if you could see them cutting back at some point to support the price.
So this is a great question and a very hot topic of debate, I think, amongst analysts and traders. OPEC has left themselves a tremendous amount of optionality. They're not going to increase production until March, as they stated, but they left themselves the option to either cut in March, increase, or stay flat. Based on what I'm seeing in the marketplace, my assumption is actually that they decide to do nothing for the second quarter. And I say that because in the face of falling U.S. production, if we get into the high 50s, the market is going to rebalance itself a little bit more naturally. And they may not want to give up that market share by cutting at the same time when they think the market might be reaching a level of support. So I don't see them necessarily stepping in as quickly as they have in the past to cut production to support the market, as I think they think the U.S. will be a little bit more responsive. On the other side, I actually don't think I see them increasing dramatically, particularly because we will be in a surplus. This isn't a market that's in a deficit. We're expecting builds. And if they add barrels back, it could have a pronounced impact on price, which I think they want to avoid. So my assumption here is they stand pat. It's obviously very difficult to call, but at this point, that's kind of the way it looks like it's shaping up for me.
Okay. What about China? Is China still stockpiling? And how is the cutoff of Venezuelan oil affecting that country?
That's a great question. So China was a huge stockpiler of oil throughout all of 2025. Estimates vary. It's hard to get a really good read on it, but it could have been at as high as 500,000 to 700,000 barrels a day that China stockpiled throughout the course of 25. Yes, they continue to stockpile into early 26. This is something that the market has started to build into their estimates. So it's reduced the amount of surplus that many analysts are anticipating. If you were seeing about 2.5 million barrels of surplus in the first quarter of 26 into the second half, you might be saying, okay, maybe it's something closer to 1.5, 1.7 based on China's potential stockpiling. So I think they continue to be active. The data is yet to reveal the full amount that we're going to see in 26, but analysts are certainly expecting that trend to continue, particularly in the events of geopolitical risk increasing. As it relates to Venezuela, I think all of the geopolitical risks we're seeing are impacting China's decision, not just the Venezuelan crude instance, but we have seen commentary from Trump that they should be able to continue to buy Venezuelan crude, but I don't think that changes their calculus. I think they'll continue to be very active.
Rebecca Babin, Senior Energy Trader, CIBC Private Wealth. Thanks for your time.
Thank you.